And hello, and as always, good morning, good afternoon, good evening, depending on where you are around the world. Thank you very much for attending. My name is Brian, and I'm speaking to you on behalf of Jupiter Peak Financial, a financial education firm, as well as IBFX. I always urge people to ask questions throughout the webinar, so please type those in as you have them and I'll try and answer them. You have my email there if you have any questions, and then you have my daily market commentary where I post articles about the Forex markets and about the markets in general, trading psychology, fundamentals, and technicals right there at the bottom, dailyforextradingedge.com, the IBFX site where a number of different collaborators go ahead and post articles. So I've posted articles Monday through Thursday there, so there's 4 articles this week for you to catch up on, and we'll probably cover some of that material as I've been prepping for this webinar tonight through those posts. And so it helps me, and hopefully it'll help you, and if you're reading them, then you're caught up and understanding what we're talking about a little bit tonight. So again, please ask questions as we roll through these slides. Tonight's topic, using trends to enter trades. I'll show this disclaimer for just a moment and let you peruse that. And again, this disclaimer is very, very, very important. No matter what type of trader you are, no matter how long you've been trading, you know that the markets can become quite volatile at any time. There can be surprises, news and announcements, rumors, and so having a trading plan is a very, very, very good idea. Always using stops, using targets, using money management, having an idea how you're going to manage that trade from beginning to end. So trading with a trading plan is a very, very, very good idea. The outline of where we're going tonight. We're going to do a quick fundamental analysis, a quick catch-up of events since we were together 2 weeks ago. We'll talk about then the main part of tonight's topic is going to be trend analysis. Why is trend important? And we'll look at the fundamentals as far as helping us to maybe see a trend starting to take place. And then we'll go into technical analysis. So obviously talking about trends is technical analysis. So I'll define trends, I'll give some examples of trends, and then we'll go into those live market examples. We'll talk about some long-term opportunities, some short-term opportunities, and I'll always discuss those intermarket relationships, having the use of other markets, entities to help us with the foreign currency markets. So that is the outline for this evening. Fundamental analysis. Let's just do a quick discussion of current events and what they mean for us as traders and investors. First and foremost, economic data around the world. I follow it. Your broker, IBFX, gives you a link to it, and that link is forexfactory.com. I have that pulled up, and we're going to go to that in a moment. Other ways to pay attention to the fundamental news, the macro news driving events. I just gave you one, the Daily Forex Trading Edge, where I do that for my clients all around the world, depending on what type they're trading. I try and give a broad macro view, so take advantage of that. It takes you a few minutes to run through that. Again, your broker is providing information through different collaborators. The Forex Factory, which I mentioned, CNBC, there's a worldly version of that depending on where you are, so you can pay attention to what the markets are doing, breaking news, things like that. And then other websites such as Bloomberg and other ones that you're using out there. My opinion, I still think economic data is weak, and if it weren't for governments intervening, European intervention, the Federal Reserve here in the United States, I think that the markets, the equity markets, could be going lower. They're not. I think that there is a somewhat of a bid to the equity markets, and that's keeping volatility down, and we'll look at that and look at that relationship briefly. But the bottom line is the markets are volatile. They've been actually fun. The last hour of trading has been a lot of fun in the United States equity markets, and that's been transferring over to late in the foreign currency markets. So it's been around maybe 7 p.m., 8 p.m., 9 p.m. GMT time. Has been a lot of fun when the United States equity market's been closing. But volatility isn't super high, and again, why? Because I think there's a thirst around the world for more government intervention. So it's a very politically driven market. We have to be very wary of rumors or an actual event where central banks around the world coordinate with each other or just have some action on their own where they provide liquidity, lower interest rates, and try and buoy the markets and buoy the economy. So that's the major theme, is we just are trading kind of in that rough area where we know that that news could happen at any time, because economic data around the world has been starting to soften, and that fundamental analysis, paying attention to that, can show us some trends. And I'm going to show you how weakening economic data, weakening macro data, fundamental data can help us start to see trends evolve. Why do we focus on the trend? This is just from Investopedia, so I'm just taking the definition of a trend, and you can read this, but they say as a general strategy it's best to trade with the trends, and I kind of take that as, look, there's all different kinds of traders and investors out there, and people do have success going against trends. So I'm not saying that you can't go against the trend. I'm saying that no matter what strategy you're going for, and no matter why you're making a decision, you have to have trading plans and stops and money management. But if you just look at the length of the moves, the length of the move in pips going with a trend is larger than the length of a move in pips going against the trend. So I'm not talking about money. I'm just talking about pips. Just pips, just the number of pips that are going with the direction of the trend versus against the trend. Like I said, there are people at the bottom there who do a kind of what we call fading, which is going against the trend, and it can be performed very, very well using caution and trade management, and some people only decide to fade, and they do very, very well at it. So I'm not saying that trading with the trend is any type of guarantee, no strategy, any type of guarantee, but just the moves as far as pips go, the length of them, the will be a little bit bigger going with the trend, and that's what I'll show you as we go into technical analysis. So that's another great site there if you're just looking for a glossary of or a description. Investopedia.com is a really, really widely known, well-used website if you're just looking for some definitions, whether it's fundamental or technical. So let's just discuss some key fundamentals that I think have been driving trends. All right, I've talked already about fundamental analysis in the Fed. Well, in America, and I'm sure that you guys can kind of concur in Europe and other places around the world, the unemployment rate in America has not changed in the past 4 years. It's stayed about 8%. It's fluctuated a little bit, but stayed about 8%. The equity markets in the United States over the past 3 years have doubled in price. So most equity markets have gone up around the world, 2009, 2010, 2011, early 2012, because governments have been intervening around the world. So that's a fundamental point right there. There's an old adage, do not fight the Fed. I repeat, do not fight the Fed. You have Federal Reserves around the world in their different regions all working together, and they're buoying equity prices. The stock market and economic data has started to weaken over the past few months, and I'll be able to show you that technically, but the stock market is only about 4 or 5% off of its bull run highs. So economic data weakening, and there's not many sellers in the equity markets, not much anxiety or uncertainty or fear out there. People seem to be very, very confident and happy in saying, hey, Europe's a mess. Hey, America's starting to slow down. Hey, China's starting to slow down, but the equity markets can't go down. So you use the fundamentals to make an opinion, and then you use the technicals to say what's going on now, and then that's how you can start to create trading opportunities. Europe and the Euro USD, I'm sure many of you trade the Euro in the USD, and we know that there have been problems in Europe, so overall the Euro has been weakening against other currencies, including the United States dollar. Fundamentally, there's something wrong with Europe, more so than other regions of the world like America, so Europe is getting weaker to the United States dollar. We'll look at that trend. I love to use intermarket relationships. Most of you have been with me on webinars before. You've read my market commentary. You've seen me on the IBFX Connect site posting intraday. But if you're new to hearing me for the first time, I like to trade foreign currencies on a daily basis. I like to be a short-term trader. I'm kind of like a scalper, an intraday trader. I also use foreign currency markets as a hedge, and a hedge meaning I use intermarket relationships. I'm looking at equity markets, and I'm looking at equity portfolios and retirement portfolios and things like that. And so I do a lot of protection strategies, meaning I have to protect the downside. If the equity markets go down and a portfolio loses value, I have to look at ways to protect that, quote unquote, hedging. And there's no guarantees that the hedge will do well, obviously. That's my trading plan. And so there are relationships between which way equity markets go and which way the United States dollar goes in different currencies. So when China said we've got domestic problems and we've got to back off our thirst for commodities, you saw the Australia dollar weaken, because the Australian dollar, they're a commodity currency. They are deeply, deeply, deeply related, their interest rates and their economy, to commodities such as gold and so and other commodities. So when commodities took a dip, the Australia dollar took a dip. So that was a fundamental shift that we heard and that we saw in fundamental data, and then we could start to see a turn technically. Another intermarket relationship, supply and demand. I like to focus on oil prices a lot, and the Canadian currency is closely tied to energy, because that's a big commodity for them, and it's a big part of their economy. And so the United States dollar can strengthen or weaken depending on what energy prices are doing against the Canadian dollar. And then just a good example, a lot of you might be focusing on stocks and trading other markets. I definitely am, and that's why I'll pull up the Metastock. I'm sorry, not Metastock, but the TradeStation software tonight for you guys to look at. But RIM, there was something fundamentally poor within that company, and that company kept having bad earnings, and they kept having market share taken away, and the stock started to trend down, and then you could start to see what a trend really did. And so you use your fundamental opinion, and then you go and see the technicals. The first question is just coming through, and again, please, I'm pretty good about checking back here on the panel, and so please ask questions as they come up. What type of day are you scalping, and what pairs? So the question was about my personal situation. I'm in America, and so I understand my economy, and I got to compare that to one others. We also know that most of the volume does go through at the European close and the American Open. We also know that the U.S. dollar is a part of a lot of the majors, and so I try and keep it simple and make it easy for myself. I don't like to be up all night. I can't do it. I can't be managing portfolios and doing that and kind of focusing on the U.S. equity session, then turn around and start trading all night. So me personally, I'm a Forex day trader during the European close, American Open, and I mostly focus on the U.S. majors. I don't really focus on other exotic pairs. I don't live in those countries. I'm not trading when their banking centers are open, and so that's just me. Would I love to be living in Europe and trading the European session? Absolutely, but I don't live there, and I don't choose to be up at midnight, 1, 2, 3 in the morning and then sleep through the daytime. I just don't want to have that lifestyle, so that's me personally. So I'm sorry if a lot of you guys want to see a lot of commentary from me on the other exotic pairs. I did do that a few weeks ago when I went over that volatility tool that IBFX had released. So if that's something that you want me to go through, trust me, I can go and look and start to make some comments and start to go through those, and I could create a webinar if that's what you guys wanted, all about the exotics. But for the most part, I focus on the U.S. majors, those 6 majors, the pound and the euro, the Aussie, the New Zealand, the Canadian, and the Swiss franc, all against the United States dollar. So I'm trading basically mountain time, which is where I'm at, or East Coast time, for if it's easier for you guys, New York time, about 8 or 9 a.m. to about 2 or 3 p.m. And it all depends on the volatility. The more volatile things are, the more we're in front of the markets. The less volatile, the less I might be in front of the markets. Like I just said, the equity markets have been really, 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 really volatile the last hour of the U.S. equity markets, which is from 3 o'clock to 4 o'clock East Coast time in the United States, and that's a really late time for me personally to be trading Forex, but that's been a good time to see some opportunities develop, because that's when the equity markets have started to move. So every day is a new day. The ebbs and the flows in the markets, I love it, and I hope it's contagious for you guys to pick up some knowledge tonight. Let's see. So hopefully that helped you with that. Another question: can we see the questions quotes as they come in apart? Only the panelists, I can see them, so I'm just reading them off as I go through. someone else is asking about scalping. Again, I don't know you guys, and I'm going to talk about this and give you guys an opportunity to learn a little bit more about what I do. So it's hard for me to just say, hey, which is the best for scalping for me, or the best pairs, because I don't know where you live. I don't know what region you are. So you're going to have the chance to talk to me and on a more individual situation. So let's stick to the topic and not get too individualized where I'm looking at individual questions for people. But hopefully that helped you with what I do. I trade Forex short term and I trade Forex longer term because I just am aware of longer term trends, which is where we're going. So supply and demand intermarket relationships, we'll look at US dollar Canadian. RIM, we don't have to look at it, but I can bring it up just to show you the technicals, but that's just a stock that's been in a downtrend. And this is out of line here. So the coal at ports in China, one of my friends works for a mining company, and he just said there were boatloads of coal coming from Australia over to China, and China said, we're refusing it, we're not paying for it, we don't need it, we have too much. So the point was there was just too much supply there, they had gotten too much, and the demand started to slough off, and so that's the kind of stuff that you see, and that's what helps us. If we pay attention to the fundamentals in the economies around the world, that can help us trade technically. So technical analysis, see the move, see the internals within the move. An uptrend should have higher highs and higher lows, and a downtrend should have lower lows and lower highs. So now I'm going to switch applications and just move slowly so that you guys can see me. And we are going to go into, first I'm going to go into TradeStation. And I just want to bring up a couple of charts here for you guys to see trends. And I just want to show you that first one I talked about, the Federal Reserve. And so here is a trend from 2009 when the economy bottomed out and the Federal Reserves around the world started kicking in. 2009 we were at 700. 2012 we're at 1400. So we doubled in value in 3 years. Just to give you some perspective, the markets on average return 8 to 10% per year over the past 30 years. We did 100% in 3 years. Quite a return. So there's your trend. You have big moves up and small moves down. Big moves up, small moves down. I kind of say 3 steps up, 1 step down, 3 steps up, 1 step down, 3 steps up, 1 step down. And if you're in an uptrend, you should be able to see higher highs and higher lows. So I'm just going to draw. And whether you're looking at this on a 1-minute chart and looking at 1 day, or you're looking at this on a 3-year chart or 4-year chart, it doesn't matter. The rules still apply. So look at this trend line. You can just basically connect the lows, something like that. And I'll draw another trend line here on the highs, connecting the highs, something like that. And that's what we kind of call parallel railroad tracks. So right now, we're kind of in the middle of the range. You have to decide if that's a good place to be trading risk-reward wise when we're in the middle. We're not near the support of the trend line, and we're not near the resistance of the trend line. But that's a long-term trend, 3 years of the equity markets moving up. So from there, I just wanted to point out now we're going to roll into the Interbank FX, IBFX MetaTrader 4 platform, and I talked about the Euro USD. Fundamentally, there's something wrong in the Euro currency. Fundamentally, there's something wrong with a lot of currencies and a lot of regions out there, but I talk about the shining star. I've got 2 currencies, the Euro versus the US dollar. Which one should be doing better? There's no doubt about it. There's more problems in Europe than there are in the United States. So I look at a daily chart here, and we can go back all the way to last year. This is a year chart, and we can see that the euro was up at 145, and now it's down, making new lows each day, heading down 123, 122, 121, and heading towards maybe even 120 or 119. We'll see. But that is a major trend down. 3 steps down, 1 step up. 3 steps down, 1 step up. I wrote in my commentary about this maybe being a dead cat bounce, and there you have a very small retracement. So I'm bringing into trends, I'm bringing into fundamental analysis, I'm bringing in Fibonacci's, I'm bringing in a number of things to help guide my decision, but primarily my opinion is decided by the fundamentals. I know they're trying to work things out in Europe, but there's still things to be worked out. They're working things out as we go along, and right now, I can just see that we had a big move down, a very small 38% retracement, and here is another leg down and another low. So even if I didn't know what was going on fundamentally, technically I could just look at Fibonacci's, technically I could look at trend, technically I could look at how things are acting and look at resistance areas up here. If I just was looking at resistance, I see a lot of resistance right here at this 38% mark. Even if I'm not going for a big long move, maybe I just use that resistance mark to be a trader, and I can be a swing trader, intermediate trader, risking 100 pips to make 200. I'm not trying to maybe to make 1,000 pips, risking 2 or 3 or 400 to make 1,000 or 2,000. So there's your short-term and long-term opportunities. Maybe the long-term trader was short the euro going down and saying, hey, the less you retrace, the better it is. The less you retrace, the more likely you are to do 3 steps down, 1 step up, and another 3 steps down. And a long-term trader has been short the euro from 140, 130, 125, whatever it may be, and keep going down. Whereas a short-term trader might say, hey, I'm willing to take this up move in the euro, and I'm fundamentally bearish the euro, and I'm technically bearish the euro, and I use my Fibonacci or whatever it is, and I sell the euro at 126, and I put my stop in at 127. And I risk 100 pips. And if it moves down 150, 200 pips, I risk 100 pips to make 200 pips. That's it, and I'm out as it moves down here. I traded with the trend. I used resistance. I used a Fibonacci. I paid a little bit of attention to fundamentals. I created a trading plan with a stop, with a defined amount of risk, and I have a reward with a plan of where to get out that is a little bit bigger than the risk that I was taking. That is a solid trading plan. That's what I'm looking for you guys to be able to develop on your own. Just checking back for questions. Can you please spot on chart the 3-step area down and 1 step up? Yeah, I'll go back to the euro here and just show you. I mean, basically, I'm just saying any move in the direction of the trend is pip-wise larger. So I'll just go ahead and draw it here with a trend line. So this move down, okay, is 3 steps down, and then you have your, whether it's 1 or 2 steps up, okay? So there's your move up, and that's your sideways consolidation. And then here again, going with the trend, here's your 3 steps down, okay? The down move from 132 to 122, that's what? 10 pennies, 1,000 pips, and it only retraced up from 122 to 126. It only retraced up 4 pips, so it went 10 pips down, 4 pips up, and then it went 5 pips back down, and we're not done yet. We might still go further. So you have a big down move, a small up move, and again, I'm a big Fibonacci guy, so I could put a Fibonacci here of this move, and you can see the big move is down, and then the small move is up. It's only a 50% retracement. It only moved up 50% of the down move. So this move went from 141 to 126. That's 15 or 16 pips, and then it went from 126 to 133. It moved up 7 pips, which makes sense. Down 14, up 7, and the 50% mark is right there. This one went down 10 and up 5 or 4, and right below that 50% mark. So those are the big moves down, the small moves up. Again, I told you that I would show you this move on in a shorter term basis because this is the long term basis. So we can go down to a 15-minute chart and we can see what's happening today. So just today, equity markets were weak for the most part around the world. What was the trend of today? Well, here is the day. Here it is. Here's Thursday around the world, okay? Friday in some places, but Thursday here in America. So the date is the 12th. And there you have the big move down. And basically, so big move down, 3 steps down, 1 step up, 3 steps down. And then we kind of went sideways going into the late American session and kind of went sideways. But here's the thrust of the move as we opened up in Asia. And then in Europe, they definitely were trading it down. So if you were trading here at 6 a.m., 7 a.m., 8 a.m., 9 a.m., 10 a.m., 11 a.m. GMT time, the move was down. Yes, you could trade going to the upside, but pip-wise, we went from 122. I've got to move the panel so I can see this. So I'm just going to measure the length. 122.40 to 122.07. So that's about 30 pips. And then we went up 122.07 to 122.27, up 20 pips. Down 40, up 20. The length of the move down was bigger than the length move up. Then we went from 122.30 to 121.73, a 60 pip move. And then we started to crawl back up. But again, we are making a very small crawl back up of this big move. We're probably about eyeballing it. We're probably about 50%. And you can see there's a lot of resistance. Yeah, there's that 50%. Every time it hit 50%, went back down. 50% went back down. 50% went back down. So as an intraday trader, you're paying attention to, hey, the trend is down. If I want to get on board the trend, I want to get on board the trend when the trend is overvalued, when the euro is too high. Hey, I'm up here, guys. I'm too high. And boom, and you smack it down. That's the euro. All right, moving back into these intermarket relationships, I want to show you XLB, which is an ETF that focuses on the materials sector. So like I said, commodities and things like that, big multinational companies, the materials sector. And we're just going to change the periods to bring us down to a daily. So we've been going up, 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 and then all of a sudden, I'll actually back this out so that you guys can get a little bigger reference. Let's go to a weekly. So the trend has been up. 09, big move up, small move down. 10, big move up. And then all of a sudden, we had a pretty significant move down, all right? And that was last summer. And then we started to move back up. But what causes these big moves down? If you remember what was going on when this was last summer, okay, that's when things started to get really iffy in Europe last summer and global slowdown in Europe and things like that. But hey, we recover. We started to go back up to our highs, and we start to travel around, and we're heading into 2012, and all of a sudden, May 2012, and this stock goes from $37 down to $32, a $5 move, almost 10%, really about $38 down to about 32, so 20%, a $6 move of a $38 stock, almost 20%. Why did that happen? That happened when the global growth started to slow down. Economic data started to weaken in late April, early May, late May, and all of June. Economic data has gotten worse, and the materials sector, there was just too much of it, too much supply, and the demand just couldn't keep up with that, and so prices dropped. So here you have the materials sector dropping, and it dropped all of May. And then you go back and you look at a materials stock or a commodity ETF, and you look at the Australian dollar. Australian dollar has been very, very strong against the U.S. dollar. Years and years ago, it was at 59. Then it went to 79. Then it went to $1. Then it went to $1.10. Now that we're way, way up here, we're starting to see some moves. Look at these moves. All of a sudden, something happened. Europe started to slow down in the spring, and then all of a sudden, May is when China really said, we're backing off. We don't need much. Hey, your coal is coming over here. We're not paying for it. Leaving the boats. We don't need it right now. And the Australian dollar goes 104.60 to 95, almost 10 pennies. A big move down, but that was preceded by fundamental data starting to change and starting to get worse. And it had a nice rebound, obviously, but that's a big, big, big trend down there. And then as the global market said, hey, we need bailouts, equity markets started going up, Federal Reserve stepped in, Bank of Israel stepped in, Bank of China stepped in, Europe, ECB steps in, International Monetary Fund, equity markets rally back hard, and so did the materials sector start to rally back hard. These are big, big, big moves that long-term traders can start to pay attention to. In the equity markets, as long as the governments seem to be around, there's an underlying bid keeping them up. And when they drop, it seems to be a good buying opportunity. Same thing here, when you get a significant drop, you look at it and say, hey, we're going to get helped out by the governments, and if that's the case, it's been good in the past. No guarantee it'll be in the future, hence trading plans and stops and targets and money management. But that's what happened. This move up from 97 to the dollar on the June 1st to 103 roughly, so 6 pennies, 600 pips. That happened the entire month of June. What did our stock market, the U.S. stock market, do the month of June? Let's go look at it. Let me find it here and bring it down so that you guys can see it, just to see these intermarket relationships. Here's the month of June. It went from 1263 up to, it finished around 1362. It went up 100 points That's about 8% in 1 month, and economic data is getting worse around the world. So you're seeing these relationships. Equity markets are being held with a bid by central banks, and if that's the case, then currencies that go up when the equity markets go up are also doing well. Okay? So there's your intermarket relationships, and there's trends that can help. We can use fundamental data to hopefully get us in early. I'm just checking for some questions. All right, I think I'm good. I caught up on the questions. So just going back to these intermarket relationships, you're using multiple markets, you're using fundamental data to help you formulate opinion, and then you're using technical data to help you to see trends, higher highs, higher lows in an uptrend, lower highs and lower lows in a downtrend. All right, so we've done, and again, other things happen with chart patterns. Maybe there's an inverse head and shoulders in here. You use trend lines, you use Fibonacci's, you use moving averages. You don't need tons, but you need enough to try and line up a few moons to help give you guidance as far as your trading plan, entries, and exits, and things like that. Again, I can't stress enough, trading with a plan and having stops and targets predefined before you're getting in is so, so very important. So walking back into the presentation, I just wanted to talk about one more relationship there or not relationship, but just stock. Again, RIM, which mobile device maker, a lot of you are familiar with the BlackBerry product. So, again, share has been taken away. Their product wasn't received well, and they were just having a lot of problems. I had one for a long time and just had multiple problems in a row. And so then you had Android come out, and you had these products, and then obviously Apple doing well. So fundamentally, something was going on with the company. So if you look at it, that is a severe trend down here, and it just never, ever, ever recovered, and it just dropped and dropped and dropped and significantly here as they started losing market share and market share. So this is a trend down, and it can be very, very dangerous to say, hey, the trend is down, it's too low, I think it's going to go back up. A trend can stay in one direction much, much, much longer than any of us can ever be solvent. A Federal Reserve or an ECB can step in and say, we're going to do this for the next few years, and we're going to drive the price of this commodity, currency, entity, stock, whatever it is, in this direction for years and years and years and years. It can happen, so you don't want to get caught sitting with large losers. The name of the game, manage your losers, and the winners will take care of themselves. So I just wanted to follow up with what I talked about being excited about trading, and even though it's a little bit lower volatility, and I can show you that with the VIX right here, the higher the stock market goes, the less fear there is, the lower volatility goes, and the less anxious or uncertainty there is, or the less fear. So think of this as a fear gauge, and think of this as the lower volatility is, the lower trading opportunities are, the lower trading ranges are. So we can still trade. We just have to be wary of what volatility is telling us. So I'm very big on having volatility tell me how big to trade, how frequently to trade, how to manage my trades, how realistic to be about this profit versus this profit. In this markets, I think taking your gains quickly is a good thing. I think managing your losses is a good thing. So no guarantees out there. Trading plans are a must, but in low volatility markets, if you're doing well and seeing a gain, you book that profit. An announcement could come out at any time. Things could change and go sideways. The markets could get slow, that day, whatever it is. In this, when volatility is low, when trading ranges are low, book your gains quickly if you have them. Manage your trades. Move your stops. You've got to be always on top of your trade. That's why you have a trading plan in place before you make the trade. So just to show you today some intraday trading on some of the pairs, the New Zealand was a lot of fun. The New Zealand US dollar had a pretty big range today. So on a 15-minute chart, the range of the New Zealand dollar today went from a high of a 79.50 or so, 79.60, down to 78.56, 100 pips for a pretty slow day with low volatility. That's a pretty big range. So the markets dropped early on and around the world, and the New Zealand dollar dropped around the world. And then all of a sudden, the United States market opens right here, 13:30 GMT time, and the markets opened down 100 points in the stock market. The market started going down 80, down 70, down 60, down 50, down 30, down 20, down 10, down 5, flat, up 5, up 10, and then it's closed down a little bit. So the markets rallied all afternoon, and during the European close, American session, the New Zealand dollar rallied from a low of about 78.67 up to 79.05, and there was that relationship. So the trend all early on, before I was even up, when I'm sleeping, was down. The trend changed, and I'm a short-term trader trading for 10 pips, 15 pips, 20 pips. Which way was the trend going when I was working? It was definitely going up. I had to be aware of that. All right? So that's how minute a trend can be, depending on if you're a short-term scalper or a day trader, like many, many of you are. You had to be cognizant what the stock market was doing. You had to be cognizant that this was a big move, and maybe the New Zealand dollar was just oversold. The stock market was oversold, and they moved in tandem. They don't always move in tandem, but that was what they did today. All right? So I can't stress those intermarket relationships enough for you guys. So hopefully you guys are able to see some trends there. Let's see if I have another question coming in. How do you determine low volatility in terms of pips or, yes, so on average last summer we were seeing 150 pip ranges easily or more in all of the majors that I'm talking about. Now we're seeing ranges of 60 pips, 70 pips, 80 pips. And not only that the ranges are smaller, but the moves just die out quicker. You have a move and then you have sideways action. So I'm a day trader. I sit in front of the markets all day. Doesn't mean I'm going to trade every single day. Depends on what the markets give me. So all depends on the volatility every day. I expect to not be able to trade every day. I have to. If I expect that I'm going to trade every day, I'm probably going to be impatient. I'm going to force something. I have to let the markets come to me. In these markets, if I go 2 or 3 days without trading, that's just fine with me. I have to be patient. I have to wait for things to come to me. For whatever reason, I don't trade that late. I don't usually trade till the bell closes in New York. But the past few days, for whatever reason, the markets have gotten really active that last hour, and there's been some good opportunity and good movement there. So every day is different, but yes, overall, the average trading range per day is definitely a lot smaller when the volatility is lower. So you can just look at the pips, look at a daily chart over the past year, and just see the range of that the pips are trading per day and start to get a guide there. So good question. So going back into the slides. I do a lot of posting. I do webinars. I do the daily market commentary on the daily comments on the IBFX Connect site. I'm even commenting when I see people having good gains and winners and things like that and saying, hey, good job. I want to see you guys achieve that. If for some reason you guys are unclear at all on when you should be trading, how large you should be trading, how fundamentally and technically you can put together a trading plan, and not how easy it is because it takes a lot of work, but how I think that you can start to create safe places to put on and engage your trades, and then how to actively manage your trade and have an idea of how to manage it for your personal situation, because everybody's different. You guys are all a puzzle piece, and you guys are all a different puzzle piece, and there's the markets, and it's scattered, and you have to fit yourself as a puzzle piece right into the markets. And if you don't know how to do it, it can be a recipe for disaster. You have to be realistic for your situation. If you want a 30-minute interview set up via Skype or phone, you email me and say, I'm interested in having that. Please give me your unbiased opinion, Brian, of my situation, and I will. I shoot straight from the hip, and I will tell you what I think is achievable given your situation. You're the system, and once you know that and know what your system means, I think that you are set up for success in the market. So I want to see people do well. That's what I do. I work with others of all levels, of all sizes, all different markets, all different time frames, and it's basically your chance to hear my unbiased opinion and have my second set of eyes basically give you kind of just a real straight and narrow focus for you as that individual trader investor. So someone was asking, what do you think about China GDP? I don't really know. Because I haven't focused on it, because I'm about to go to bed and I'll wake up tomorrow for my trading day and I'll do my research, so I haven't gotten a chance to even look at that. You're looking at the past. How do you estimate what's going to happen? There are no guarantees out there, but the bottom line is we're looking for low-risk places to enter the markets that have a high reward compared to the risk that we're going to take. There are no guarantees, but the goal is to get into places that we feel that we have a good edge and we manage the loss, and as long as we have good locations, the winners should take care of themselves. So there are people that are profitable in markets, and so no matter who they are, you ask them, because there are people that are doing well in the markets, but it takes experience, it takes time, it takes knowing who you are. Like I said, you're the system. Once you do that, then you can learn the fundamentals, then you can learn the technicals, but you've got to start with yourself first. If you just go in and say, hey, I've heard about the equity markets, I've heard about Forex, whatever it is, oh, I think I can make money. Who are you to say, I'm brand new at this, I'm working another job, or whatever it may be, I have family going on and other things going on in my life, and hey, these markets are going to provide an opportunity for me. They will if you approach it realistically. It's not fair for you to say, oh, the markets are there, I'm new, I'm going to do well at them. No way. If I've never done something that you do for a living, and you've done it for 15 years, and let's say that you're a marketing or sales and you have a client base, and I've never done it before, is it fair for me to say I want your biggest clients? Would you trust me with your biggest clients? There's no way. So you guys know what you do for a living, and now you're trying to learn a new skill. It takes time. It can be done, but be realistic about it. Make sure that you understand that you are the system, and that's the most important part. So moving forward to review, fundamental events, I gave you my opinion of what's going on with fundamental events, the macro and the micro events going on. Pay attention to that Forex Factory calendar or website that you can link to from IBFX. Trend analysis, the definition of trend, and then we just started to look at the length of the moves in pips or percentages if we were looking at stocks, and we got to see which way had the most length of move and where you saw areas that you could get in as far as risk reward. If you're trying to go with the trend, obviously there's different ways to do that, but you just have to be realistic, looking at data to say what is realistic here, where am I, what's going on fundamentally, what's driving it. So the fundamental forces, I think, can help you get in and take advantage of trends by using other data that a lot of people don't think to focus on. Breakdown of the trends internals, I just showed you that higher highs and higher lows for an uptrend, lower lows and lower highs for a downtrend. And then we talked about your opportunity, focusing in on you and being really, really giving yourself a gut check and saying, this is me, this is my situation, am I being true to myself? Okay, so the last question there, how do you estimate what's going to happen? We do the best we can. Like I said, that's the difference, obviously, between someone who's successful and not, is someone who's saying, I'm going to wait for places where I think that I have a good chance, and no matter what happens, I manage the losers. And obviously, traders who are successful end up having either more winners than losers or some combination of larger winners than losers, whatever it may be. But there are plenty and plenty of people that are profitable. You can use the IBFX Connect site to see that. So here's your resources. I'm talking again in 2 weeks. I'm going to add to this trending topic by adding in moving averages. A lot of you guys like to use moving averages. Some of you may not even know how to use moving averages. Moving averages don't work well in sideways markets. They work better in trending markets. That's the definition of them. You can look it up on Investopedia. So we're going to add moving averages to trends. We'll talk about fundamentals as we always do. In between now and then, I write almost every day, dailyforextradingedge.com. I just provide my own blog, but it's the same exact information on Finance Banter, so you can find it just as easy on Daily Forex Trading Edge from IBFX. There's about 23 other YouTube videos that I've created that are out on YouTube for IBFX. There's the link right there. This one should go up in a few days, so look for it on the IBFX YouTube site. And then again, if you want to follow me intraday, making some comments on the markets, my tagline is the locals take, and I'm just doing, again, fundamental and technical analysis, just kind of quick, and what I'm seeing and things like that. So hopefully you enjoyed it tonight, or depending on where you are around the world, it could be the early morning. So thank you for joining me wherever you are. Thank you for your questions and your participation. Please provide feedback at the end of this. Please let IBFX know what you need from us as educators to give you so that you're confident entering the markets. And again, you know how to get a hold of me if you have any questions on figuring out who you are as an individual trader in your system. So thank you very, very much, and we will look forward to seeing you on the next webinar in the next few weeks.